Kookie, welcome back, mate. Still shocked after the last board meeting that they didn't move rates. How do you feel about that one?
You, me, and a lot of people I speak to on that afternoon on back
August.
a month ago.
8 August.
8 August, we got that no change. I had to refresh my page because the 3.85 cash rate didn't change.
Yeah.
And so I had a lot of WTFs coming through on my text line. And but look, when you look back at what they said,
The logic of it.
what the governor said at her press conference, Michelle Bullock said after the no change, you can see that they are not, or they weren't, remember this is still 5 weeks ago, they weren't yet convinced that inflation was entrenched at 2.5%.
So let's just say, what was it? What was it that didn't convince them, though? So is it the monthly numbers, or it was because it's a monthly number?
The monthly number is not comprehensive
Yeah.
as the quarterly number. We want to see the June quarter number, which, by the way, has come out. I'm sure we'll talk about in a minute.
Yep.
And the unemployment rate was still 4.1.
Yeah.
Again, that number came out subsequently, and they were still hearing from their business liaison, a really important part of their deliberations. Obviously, they rely on data, hard data on inflation, unemployment, GDP.
But business liaison's data anyway.
Yes, today's liaison is tomorrow's data.
Yeah.
You go to big business and say, well, what are you finding? They were still hearing that there are labour shortages in some sectors of the economy.
Construction.
Yes, and there was some evidence that the economy and price pressures were lingering. They've clearly come down, but they were still lingering. So they sort of thought, or the RBA governor and the board, importantly, thought, well, look, if we wait 6 weeks, so what? For the economy, it doesn't matter that much, waiting 6 weeks.
Well, does it? What do you think? What do you think about? What do you think? Look, I mean, this is a bit more political, I guess, or a little bit different to what this is different to what an economist would normally say, but we'll be interested in. But Australians sitting there hanging out for a rate reduction.
Yep.
Yeah, it's a bit more. What do you think of
that?
That?
Look, I think it in a sense, I think it does matter. You want to get that policy positivity out there when you know that the economy's only muddling. We get a GDP number in about 3 weeks' time, and it's probably going to show bottom line GDP at about sort of 1.5%. So the economy's not that strong. And one of the reasons is that we don't have any monetary policy stimulus. It's still restrictive. So waiting 6 weeks, it's another 6 weeks where the business sector thinking, oh God, I'm not getting many customers in my door. It's another 6 weeks that the mortgage holders saying, oh gee, it's longer until I save that extra $100 a month or whatever that repayment relief is going to be. So it sort of does matter. But from the RBA's perspective, they think, well, look, it doesn't matter. And if, I'm not saying this is the case now, but if they do find out they're wrong, they can slam on a 50-point cut. As we saw with the rate hikes back in 2023, there were a number of 50-point hikes when they realised they were a little bit behind, if you think back then. And during the global financial crisis, there were a couple of 100-point rate cuts when they realised, holy smokes, this is blowing up. So they can do 50, 75, 100 basis points if needed. So for them, waiting 6 weeks doesn't matter. But it sort of does matter a bit. I want to get my sugar hit now.
I
putting it off.
I get nervous. I'm not nervous. I get a little bit concerned about that attitude. Yeah. Because it's sort of like playing God a bit, I know it's not. They're not. They would always deny that position, but there are some poor buggers out there who made it just. Please give me a rate reduction, and then by the way, they just want the news of a rate reduction. They're not going to get it for a couple of months because it takes that time to wash through the system. But they're dying for it. They're desperate, and then it might only be 2% of the total economy or 2% of all borrowers. It doesn't make any difference. There are people out there who need it, who need to hear this good news,
and they need to hear it. One, to improve their personal financial position, which of course is really important, but also then as you said, there's a lag between the effect of the rate cut today, if we got one, and then it's passed on, and then you realise in your bank statement, and then you realise, oh shit, I'm saving $100 a month. Oh, and then I can go and afford to spend $50 a month, say. So you get the economy being stimulated. That lag,
we'll just sleep at night,
is 3 to 6 months, or just say, oh, thank goodness I can. My repayments have gone down,
more affordable.
And the business person, the business owner with an overdraft is saying, well, I've saved a few bucks. Thank goodness for that. I can, quote a few more.
I can now buy one coffee a week.
Yeah,
instead of having to make a percolate one at home.
And that's this whole issue about how money. By the way, Mark, that's how interest rates work.
Yeah.
When they're going up, they're sort of taking money out of our pockets, putting it into the pockets of savers through deposit rates going up, and the economy slows down, inflation comes down.
Well, let me ask you about this.
It turns around when we have rate cuts.
Well, let me ask you this, Steve. During the rate rise period, you mentioned there was a couple of 50s, 50 basis point rate rises. During the rate reduction period, and they had no compunction whatsoever doing that.
Oh, yes. They just slammed it on and the market said, yep, go for it.
And we must save this joint. So I'm going to...
And inflation was, as we remember, going from 1% to 3% to 5% to 7%.
Now,
yeah.
Why? Let's talk about, or maybe you could give us a bit of insight. It's the personality of the RBA.
Yeah.
They make the decision about their personality. We don't. Jim Chalmers doesn't, although he does appoint everybody. But they, in the end of the day, make their own. We're going to give you the personality. And previously, Glenn Stevens, previous RBA governors have been what they call preemptive, or much more preemptive in their decision making. Maybe not the governor himself, but the board. And we do know, it's been disclosed for the first time, the vote was 6-3, 6 in favour of doing nothing, 3. We don't know whether they want to say they want to put them up or down, but I'm assuming they're going to say down.
Yeah, yes.
And we don't know which members they were either, which
correct.
That's interesting. But maybe you could just talk about the personality of the Reserve Bank now. Yeah.
The Reserve Bank now, with Michelle Bullock as governor, Andrew Hauser, recently appointed as deputy governor, recently 18 months ago, 2 years ago, thereabouts. The other makeup of the board is the Monetary Policy Board, which is made up of a number of academics, ex-bankers, a couple of economists, and a couple of people who are labour market, LABOUR, union-type people who talk about wage pressures and labour market reform. So it's not a bad composition. And they sit down with the research and analysis of the RBA, and of course look at the data
of the bureaucrats,
the hundreds of economists working away in the RBA,
literally hundreds.
Yes, and say, well, these are the pressures that we're seeing.
They make a recommendation, don't they, Steve?
They still do make a recommendation, and that is debated around the RBA board table. Yeah, I agree, I disagree. What about this? And it's a fulsome discussion. I think that's great.
And it's now 2 days.
Correct. Day one is the theoretical discussion. What are we seeing, and more what we might call economic wonk. Looking through the data and modelling and all that stuff. Day two, I think, is, well, what the hell do we do? Do we keep them steady, put them up, put them down? All that sort of stuff. Back in the day, and you mentioned Glenn Stevens, who was governor, a decade or more ago. He was the master at preemptiveness. And by that I mean he would sort of see the data, of course, on the economy as it evolved. Unemployment, wages, inflation, all that stuff. But then he was also looking forward, not necessarily wedded to an economic model, but when he saw, gee, I'm looking overseas and I can see the Chinese economy is a bit weak, the tariff war, while markets are still very buoyant, stock markets are strong, it's not going to be good news. And I think I've got enough evidence from the hard data, plus when I look through the windscreen rather than the rear view, I can see some problems. So I'm going to trim 25, even though inflation is still 3.0, because I know the pressures are coming down. Current RBA board and the RBA staff, the people who work at the RBA, are more, well, here's the hard data. Yes, they have models. Yes, they have tried to be preemptive and all the rest of it. But I think they are more dependent. I think the dependency parameter is more on the hard data. And until we get inflation comfortably at 2.5, and until we see unemployment spiking higher, we'll be really cautious with our rate cutting cycle. Put it this way, I reckon in the olden days, and I can't prove this, of course, but if Glenn Stevens was governor, rates would have been cut. He would have said, look, inflation, because back then was 2.9 on the trimmed mean, unemployment was 4.1, but I can see some headwinds coming domestically, internationally. I'll cut them. I won't say that there's going to be more to come, but I'll cut them now because I need to now, and then that preempts the economy in 2026.
So there's nothing in the mandate or in any guidelines which tells the RBA what type of personality to have. They choose their personality, and we would call the current RBA, therefore, more hawkish on data.
More hawkish on data and more reactive to news. Mark, you and I have been around the block 1,000 times.
Way too long.
But that means, and how many times have we and all of our mates in markets and all the other economists been surprised by economic data.
Well, and by the way,
so is the RBA.
And they say we got it wrong.
Yes, I thought the unemployment rate would be 4.1. Oh, God, it came out 4.3. I thought GDP would be 0.2. Oh, it's coming at minus 0.2. Yeah, we get, or employment plus 20,000. Oh, minus 10,000. There are data surprises, and that's not just you and me. And I'm not throwing stones at any of my economist mates out there, but we aren't able to forecast those monthly numbers very well. And so what that means, of course, is that we get these numbers, these surprises, and those surprises can even be in the form of a pandemic coming along, Or you think I remember 3 months before Lehman Brothers collapsed in the global financial crisis in 2000.
Very huge.
I think the cash rate was 7.25%.
Yeah, I remember lending rates was nearly just under 9.
Yes. And I think, that was appropriate because we had a mining boom, inflation was high, all this other stuff. And then along came this shock. Along came the pandemic. Along came Trump tariffs. Stuff happens all the time. Dare I say, geopolitical conflict in Middle East, and even though oil prices are still pretty low, but there's all this stuff going on. China, Taiwan, and the US. What's going to happen there? I don't know. I wouldn't be surprised if we woke up one morning and something's escalated that's caused the markets and the economy to change, or it could even be a natural disaster. There's earthquakes in New York at the moment. Now they're only low, but imagine a serious earthquake in New York or California or in Japan. That changes markets.
Or a plane crashing into the towers.
Correct. All that stuff that how you can't forecast. It's impossible.
But
it does impact on what you, the RBA, do when you get that fresh news. You might think, gee, I thought we were going to have this problem, but the world has changed in an unexpected way, and therefore we have to react to the news that comes out.
So what do you think about, I mean, and I know our listeners that maybe have their own opinions on this, but I'd be interested to hear, especially someone like you who's had close ties to political figures in the past. What do you think about not having a preemptive mindset relative to not being prepared for shocks? So, shocks to the system. So let's say, for example, we've all got it wrong, including the RBA, and actually we're heading towards a really high unemployment number for the next big number that comes out, a really crappy GDP number for the next number that comes out, and a really good inflation number for the next number that comes out. And all of a sudden, people have been suffering the whole along the way, and our RBA hasn't been reactive enough, quick enough, like on 8 August, on 8 July, I should say, and reduce rates. I mean, and I know the response from them would be, well, it's only 1 month. But still, 1 month can put someone into bankruptcy.
But that's when they go 50. That's when they say.
Then it's too late because someone's gone into bankruptcy.
Yes, the problems have already occurred.
Or the bank's moved and sold your house.
So yes, rather than you having that relief and thinking, I can keep my head above water just for this extra couple of months. Another rate cut comes, I'm sort of okay. My business picks up a bit, and I survived that terrible position in the economy.
Or I lost my job, and getting a new job is really hard.
Yes.
Because I'm, 60.
Because unemployment's going up.
Oh, I'm 60.
Yeah.
I'm 50, you know what I mean?
And I used to work at General Motors in Geelong. You know what I mean?
Yeah.
And this is the other thing about, just by the by, I know a lot of my mates and a lot of economist mates, I don't think they've published it yet, are having some sort of AI Reserve Bank board approach. So they're pretending that the board is just artificial intelligence. What would the Reserve Bank do with these facts?
Yep.
And in a funny way, by definition, it's going to be reactive because it relies on the history on all the economic indicators. And so can we have the RBA board replaced by artificial intelligence?
I've tried that, by the way.
I've tried it as well, but I haven't done it. Some people have gone into a huge degrees of detail and really specify what you want the AI to spit out back at you.
But you can't ask it to be preemptive or hawkish.
No. So what should they do today based on economic news? And yes, I've seen people sort of frame the question differently and they get different results.
Yeah, I've tried it. And
it's great fun.
I found it hallucinates a little bit, to be honest with you.
Yes, However, and that's why we need an RBA board with humans.
Yeah.
Heaven forbid, I'm not suggesting it for 1 second that we need AI to run monetary policy, because you do need that human touch, and you do need that. Data's there. We all look at the same data, but we can interpret it differently. And that's not, and there isn't skill to that or an art to it, that you sort of see that unemployment number and the job vacancies coming down, and you see the retail sales being soggy, and look, and you form a judgment about how these
based on what we've seen before, though.
Correct.
We can say when we've seen that before,
we've been worried.
Yeah,
Well, that's been great. That's been no problem at all. So
Yep.
yeah, correct. Exactly right, Mark. So that sort of experience, I suppose you could call it, that nuance in sort of, it's like driving a car. You can anticipate things a bit, and you can sort of see, oh God, that guy's running radical. I better pull off and let that stupid clown overtake me. Or, but if you're a brand new driver, you think, what's going on here? You don't know. So in a sense, that experience is what the board brings. And that monetary policy board, as we were just chatting about a minute ago, is good. That they've made up of the right people, and it looks like, given that we had a dissent 6-3.
Yeah, but mate, that's what bothers
me.
That's a discussion. But that bothers me because it wasn't unanimous. So it tells me that there are three. I don't know who they are because they don't disclose. But there are three obviously quite capable people who didn't agree with the other six. Now, wouldn't it be funny if it was wouldn't it be funny if it was Michelle Bullock and would be.
who were the ones saying the cut, and it was the other one saying hike.
Well, that's what going through my head. Or is it someone who's got a better consumer base experience who knows how consumers really suffering? And
correct.
When it's 6-3, it'd be different if it was unanimous.
That's easy. Yeah.
But if it's 6-3, I'm going, wait a minute. There's three prosecuting rate reduction.
Yes.
And
smart people, by the way.
Correct.
Yes.
And with good and the best, they've got the best knowledge because it's all been supplied to them by the RBA group. The bureaucrats.
Yep.
And they're saying, well, we don't think that. I mean, imagine if it had to be not 6-3, but 5-4. Now,
yeah.
Or does she get a
casting vote?
Yeah, they used
because there's 9, and she only has 1 vote.
Yeah, can't have it. Don't.
And so does the deputy governor.
Yeah, right.
Now I'd be shocked if they voted differently.
Yeah, me too.
So there's 2 that vote yay or nay or whatever.
Well, mention of the
others.
So why would a majority? Why does majority carry the day?
Yeah,
it doesn't make sense.
Rather than the weight of the opinion. And that's what, remember also that the Treasury Secretary's on the board too.
Yeah.
That, the person who's, the right-hand woman, Jenny Wilkinson of Jim Chalmers, she's ex officio. So the Treasury Secretary, whoever that is.
Yep. She's not a board member, but she's
on the Monetary Policy Board.
Oh, she's on the Monetary Policy Board.
She votes for up or down or steady, just like Stephen Kennedy, who was on the board, and I can't remember.
And now he's joined the Prime Minister's
PMO, Prime Minister's Department.
Yeah.
So those people, again, they're smart. They know. And they sit around the board table. Can you imagine 9 people around the board table? They get staff in to present different parts of the economy to them. So I can't be 100% sure because I've unfortunately never been on one of these board meetings. But I reckon last time they would have had the person who's done the in-depth research on the effect of tariffs, probably would have come in on that Monday before the Tuesday and had an hour's conversation about this is what we are seeing as possible risks from the tariff war. And that person would have presented around the board meeting, oh, that's interesting, that's whatever, and asking questions. Now, that's one component of that whole discussion. And that's why it's such a, such a grey area. Sometimes it's easy. The economy's weak. We're in a pandemic. The economy's sort of in a screaming hole. We're going to cut rates. That's easy. Then the only question is, do we cut 25 or 50 or more? But when it's like this grey area, we've got, the economy's not dreadful. We've already cut a couple of times. I'm not so sure. We're hearing bits and pieces from our very clever modelling staff in the bank. And what do we do?
So because then we got 6-3, and then 6 in favour of no reduction and 3 probably in favour of reduction. We don't know who they were. We don't know what the weight is of those particular individuals relative to the decision making. And someone may argue everyone's got equal weight. Fair enough, but then 3 days later, I think it's 3 days later, 4 days later, the unemployment number comes out.
Yes,
at 4.3. Now,
and that was, again, we're talking about data surprises. That was a surprise.
So just on that, is there anything in that would require adjustment in that 4.3?
No, I think it was a legitimate number. That was actually, there's not a quirk because of some other little thing happening.
Yeah.
No.
No, there's
it was a pretty reliable number.
A reliable number.
Yep.
So I wonder whether that would have made any difference at the time, or do you think they still needed to see the inflation number? Because we talk, when we look at your checklist, we talk about GDP, inflation, and labour markets, and like unemployment. That is employment, unemployment. Because you and I have bored everybody with the Nauru discussion, and it looks like we're getting closer to the sweet spot.
Yes.
Which is, I think, is currently 4.5.
According to the RBA, it's 4.5. Just by the way, if I can just interrupt for 1 second, the good folk at CBA, Commonwealth Bank, their economics department did a piece probably 2 months ago looking at Nauru. They reckon it's near a 4.0.
Really?
Yes. So I can dig that up and have a look at it, because they were just sort of saying, because wages are starting to decelerate a bit. There's not that tightness in the labour market. So maybe it's near a 4 rather than 4.5. And a lot of people might say 4.5 unemployment, it's a similar number. But when you're fine-tuning interest rates, when your 25-point cut that you deliver
and everything's data-based
and data-driven, if you sort of have that as the back of your mind, that 25-point rate cut didn't happen because the RBA still reckons it's near a 4.5, I think, and it might not be that high. So, yeah, it's a really important consideration.
So what do you think they thought then at...
The 4.3 that came out the other day. Well, funnily enough, the governor did give a talk to the Annika Foundation about another week after that. I think it was the 24th of July. And she was actually asked, would you have changed your mind had you had that unemployment number? And she said no. She said we were sort of anticipating, or we are anticipating, the unemployment rate to creep towards 4.3%. Now, we got there in June. So she said it wouldn't have had a big influence on their decision-making. And that, of course, was before we had the June quarter inflation data.
Which came out the 28th.
Which came out 28th or 30th, whatever.
No, 30th, I think you're
30th
right.
of July. So it came out a couple of days after the speech. So again, here we are talking about data-dependent. We're data-dependent too. We need to see these numbers. So I think if we get one more or two more employment, labour market numbers, and if we get to a 4.4, like 1/10 away, like that's nothing in the scheme of an economy of 14.5 million people. We're a big economy, almost $3 trillion economy here in Australia, don't forget. So if you just get a 0.1 change in the unemployment rate and it's up, that will be the thing that the RBA will go, okay, we've now running a risk. And of course, they overshoot. And by that is fine-tuning an economy is really hard when there's so many moving parts.
They have been pretty good at though.
They've been pretty good, yes. But if they just get there, and this has not been critical at this stage, if they just get the analysis of the tariff effect a little bit wrong, or they get the effect of consumer spending a little bit wrong, that we haven't responded to the rate cuts and the falling cost of living pressures because inflation's back down, these sort of things, even by a small amount, then of course, they've got to revise their forecasts, and therefore they revise their interest rate profile, and therefore they deliver more rate cuts. And that's this whole scenario when we're sitting here thinking, well, where will rates be in a year? Well, whatever I say today will be wrong. I could probably get the direction right. They're probably going to be lower. I'd have 95% confidence about that. But whether it's 3.3, 3.1, 2.8, there are so many moving parts.
So then at the end of July, the ABS printed their CPI number, inflation number, both headline and trimmed. Headline was unbelievably good.
2.1.
Beautiful. But of course,
annual.
Of course, that's sort of not quite accurate. Well, it's accurate, but it's not necessarily the proper reflection of what's actually going on in the economy, because, there is all sorts of things that go up or go down as a result of various government policies. One of which, of course, is, the $75 a quarter. It is.
Yeah, the electricity subsidy, which is still there. And it's for another 2 quarters, by the way. It comes off at the 1st of January. In the election campaign,
they extended
one of the promises was a 6-month extension. So it's still there for the September and December quarters. It drops off in the March quarter 2026. So that's where everyone's expecting a big jump in headline inflation.
Yeah. Now, do you think when the subsidy disappears in January, do you think that, which means that headline inflation will jump, it'll go up because electricity prices now will be baked in, and electricity prices is one of the biggest. It's a big, heavily weighted number. Because everyone uses electricity, everyone, everywhere,
every household,
or every business, it's baked into everything, in the price of everything.
Correct. Exactly.
Do you think that they'll trim that out?
Yes, they'll trim it out on the upside, just as they've trimmed it out on the downside. So and this is why there's quite a big gap between headline inflation and the trimmed mean. The trimmed mean,
it's nearly 1%.
Yeah, because we're 2.7 for the trim mean and 2.1.
0.6%, yeah.
And that part of it's petrol too, because petrol's actually was cheap in the June quarter, still is so far, September quarter. And that was a big volatile item. But what the RBA do, because those things like tobacco, which is excise tax, and we won't get into the tobacco tax discussion, but the whole methodology or reasoning for trimming out volatile price items. It's not to say they didn't exist, because I'm happy to save $75 on my electricity and saving $10 when I fill up my car because petrol's down. Fine, that's all good. So that's cost of living. But for the RBA, they know that, as you said, January 1, 2026, prices of electricity, you won't get that $75 subsidy. So your full fee, your full quarterly bill will be much higher. Who knows what happens to oil and petrol prices, but it's not impossible. I think they go back up to $2 a litre. So, they'll take that out because that is not what interest rates are managing. Interest rates are managing, they have an effect on the economy, but interest rates are managing our borrowing capacity, our debt repayment schedules for the household and the business sector. They put a potential hurdle into, will I undertake that investment or buy that property? Oh, this interest rate, I won't, it's a bit too high. Oh, 50 points lower. Yeah, I can afford to borrow an extra 50 grand. I'll go and auction and buy that house. Or instead of buying that house, I'll buy the other house, which is a bit more expensive, but I really love it and I can afford to do it. So it does work. That's, how interest rates work. And that's what they're trying to target. It's that psychology, the mentality, and even the hard facts on borrowing and debt servicing obligations by adjusting the interest rates to change how you and I and all the listeners behave, to impact economic growth, to impact inflation.
It's and it is a psychological game, a game of psychology, probably a better way of putting it. Yeah. Just interesting on that, and we will get onto the hard stuff in a second. But just interesting when we talk about cigarettes and the excise on cigarettes. So, I don't know what it costs a packet of cigarettes is $60 or whatever it is.
Yeah, something horrendous.
But you know what's interesting about that? I was reading a report the other day and says that most of the cigarettes that are bought in Australia today are illegal, and they're paying for $20 a pack.
Yeah.
And what's interesting about that, though, is if you actually add the amount of cigarettes that are bought at $20 a pack, plus the amount of cigarettes that are bought at the legal ones with massive excise on them, and let's say it's 50-50, and you divide it by 2, the price of cigarettes have actually come down.
Yes.
But the RBA does. But the RBA does look at the black market.
And I don't know if I should disclose this on the webinar, but I'm aware of some people who are tobacco addicts. They're smokers. They're not going to stop. They've discovered where you can buy the cheap ciggies
everywhere.
And it makes, because they're addicted, they'll go to the cheap place.
Of course.
And pay $15-20 a packet rather than $50-60 a packet, and
why does that doesn't get included? How?
Yeah, so that's just the black market.
Yeah, I understand that, but it is
doesn't get counted in GDP.
But consumers,
and of course, the government doesn't collect any revenue. They don't collect the.
But consumers still spend it though.
It gets caught up because as the what do we call it? The crook who's selling the black market tobacco then goes and spends it and does things,
but the consumers spend it too.
And the consumers spend it. So there's money. There's still money. The black market is still part of the economy.
Or the tax officer will tax it.
If they spend it they have to pay GST on their things that they buy legitimately. Yeah. So, but for the tobacco, that's a different sort of question. Yeah, I think the excise has gone up so much that it has fueled the black market because, when there's a market distortion there, crooks can come. It's like other drugs.
But we've got a data distortion too then.
Marijuana and these sort of things, if it's illegal, then someone will come in and sell it to you.
For me, they should take cigarettes and alcohol out altogether because it out of the
CPI basket.
Out of the basket, yep. Because it's distorted.
It's massively distorted, and it does we were talking about the headline CPI before, petrol prices and electricity subsidies in and out, going in and then coming back off, all those things, which are cost of living for sure. But for the Reserve Bank, when you've got an excise change on, your tobacco and alcohol, and they've got quite high weightings. In fact, the other day I had a look.
Because everyone used it.
Tobacco and alcohol, they've got a bigger weighting than electricity.
No.
They do. People spend more on alcohol and tobacco than their electricity bill. And when you think about it, Mark, I think the average electricity bill, depends on summer, winter and all that sort of stuff, is about $300 to $400 a quarter, approximately.
Yeah,
Let's say it's even
$400
$400 a quarter for an average normal household, whatever. Think about that. That's there's 12 weeks in a quarter. That's $30, $35 a week. Now, decent bottle of wine's $15, $20.
Yeah.
So, a couple of beers at the pub's easy $30. And so you think about that. So
Makes
people
sense.
actually spend more. This is the thing that I find staggering. This is the thing about data, and I love being an economist, as you know. Sometimes you dig into the data and think, my God, people spend more on that than they do on electricity. So do we need a subsidy for alcohol drinkers? And,
You won't get it.
You won't get it. No, because that's that's for health reasons that we've got excise on those, health reasons and tax reasons, yes. So, but those sort of things make it fascinating, absolutely fascinating.
It's very interesting. So we the next meeting is next week.
The 12th, Tuesday the 12th
of August,
2:30 Sydney time. They make their announcement on
right.
Up, down,
so they meet
whatever.
Monday, Tuesday.
Correct.
Monday and Tuesday. And let's just go through your board, like your checklist, because
a few things have changed since last time.
Righto, mate. What do you reckon?
Okay. And remembering that on our checklist here, it's the items near the top that are the most important. These ones are less important. They still have some influence, but it's really the top that matters. GDP, we haven't had any new news in the last few weeks. So we know that GDP growth's 1.3% and probably only going to be about 1.5% when we get the numbers in a month's time. Neutral to easing. Pretty weak.
So in other words, that's about half or close to half of what they use in their own forecasting.
Correct. We should be growing
Treasury
at
and
2.75% approximately. We're half that now.
So
the economy is weak.
And Treasury, that's Treasury too. So not just the RBA.
RBA, it's Treasury, and I think most private sector forecasts, academic economists, we should be growing. We'll call it between 2.5% and 3%. Some people have slightly different numbers, but near 3%. So we're weak. So you need more interest rate cuts to kickstart the economy.
And when's the next GDP number come out again?
It's 3rd of September.
Right.
So it's still a good 4 odd weeks away.
So she could say, let's wait for more data. But anyway, let's...
Oh, don't say that, Mark. Don't say that. Inflation. Well, as we just said, June quarter, I'm going to slam dunk that one into the easing cycle.
But it's not
the
that
momentum.
But it's still a little bit away
the
from
2.7 trimmed mean annual has a 1% 4 quarters ago. Next quarter, a 1's dropped out.
Yep.
That only has to be replaced by a 0.8, and you're at 2.5.
Well, so okay.
If it's replaced by 2.7, which I think is more likely, you're going to get your annual figure at 2.4%.
Right. Okay.
So that's the beauty of annualized numbers. You drop out the last, add on a new, drop out the last, add on a new.
As you know, I don't like it. I don't like the historical thing because I would rather have two past, one forward, and two past and 2 extrapolations.
Correct. But as things stand,
that's the way it is.
Michelle Bullock can sort of say, well, the last 2 quarters for trimmed mean have been 0.5 and 0.7, so 1.2. Annualize that, you're at 2.4. So in the last 6 months...
Well, she did do that in the February meeting.
She did that when she justified the February cut. Correct. Correct. Exactly. Labour market. I'm moving that almost to easing. We discussed that jump in unemployment last month. And yes, it's 1 month's number. But 4.3 is getting near the NAIRU.
Yep.
And if we get any downside to the labour market, that is unemployment goes up more, that'll quickly go into the easing side of the column.
And given that unemployment now is under their mandate, is something that must consider post the revision.
Excellent point. It is this the revamp of the RBA 18 months, 2 years ago. Their mandate, inflation, that was pretty much unchanged, but they've also got to take a look at the labour market. Full employment is their objective.
And I'd say any Labor representatives, LABO, UR representatives on the Reserve Bank board are going to be pushing that anyway.
Correct. So the people, the the union-linked fellow, some of the other academic economists who look at the labour market, they're labour market specialists or part of their speciality, they'll be sort of saying, yeah, we've got a bit of slack coming in the labour market. And even the RBA acknowledge it.
Yeah.
Wages growth, I'm putting that still in neutral because there's still a hint of, we get the next this is a funny thing, we get the next wages number, guess what, the day after the board meeting. It comes out on the 13th.
That bothers me.
Why didn't someone just say, we'll make the board meeting on the 14th?
Yeah.
But anyway, so currently wages growth is 3.4. It's like, as we say, the Goldilocks, not too hot, not too cold, just right. So I'm putting that in neutral. International economy, I'm putting that towards easing, even though the Fed has said they're pausing on their rate cuts.
US Fed.
US Federal Reserve, and some other central banks have too. When we look at the hard data on the US in recent times, it's been pretty soft. They had the jobs numbers.
But their recent GDP was pretty good.
GDP was okay, but the labour market's weak.
Yeah.
And the economy there is okay, but the Fed has been postponing cuts the last couple of times because of tariff issues. They're not sure how they're going to impact the US economy. But I think I look at the futures market now, there's a couple of rate cuts priced in over the next 6 months. And of course, China's still weak. The UK is an absolute disaster. We just had New Zealand unemployment numbers. I know New Zealand's not everything, but they had really poor numbers and they've already cut to 3.25. More rate cuts coming in Kiwi land. So, there's a lot still going on the neutral to easing side. House prices picking up. I'll leave that at neutral.
They shouldn't really determine interest rates.
And they're not part of the mandate, but they have a wealth effect. And, the RBA doesn't like bubbles or crashes on.
Yeah.
If house prices rose by between 3% and 5% year in, year out, the RBA would be happy.
Yeah, there's no difference.
They don't want it to be 10 and 20. They don't want it to be minus 10.
Yeah.
So, it's only when they're either booming or busting that they become an issue. Retail sales, I'm moving to sort of neutral easing. We actually had an okay number for retail sales for the month of June.
But it might have been June sales.
It might have been. So again, one of these ones that might have been just end of financial year sales. We're clearing our inventory of furniture and whatnot. And so that's why I've got it sort of easing-ish, but not a slam dunk easing. And because the other thing is that consumer sentiment picked up a bit. I'm going to put that exactly where retail sales numbers are too, because consumer sentiment was at a 3-year high. Now, you might think, oh, gee, that's nice and strong. However, until you realise there are still about 10% more pessimists than optimists. So consumer sentiment, no surprise, when the rate hikes were coming, when inflation was 8% or 7.8%, consumer sentiment was down the gurgler. Now, with a couple of rate cuts and inflation coming back down, consumer sentiment's edged up. Still a long way from neutral, but we need a bit more.
Relative to previous periods.
Yep. Building approvals, I'm going to put that in easing. Building approvals are picking up, but we need them to. We want to build more. Good for GDP, obviously, if you're building bricks and cement and all the appliances that go into a house, the sink and the dishwasher and all the white goods. We need more of that, and we need it to meet demand. The government, by the way, just came out earlier this week and said that their student intake was actually going to be revised up by 25,000. I think it was to 285,000.
Wow.
So any signs that we're getting a material slowing in net immigration and students accounted as immigration ain't going to happen.
Well, that's
so
amazing.
That puts demand on housing still.
That's amazing.
Yeah. Well, the universities, I think, have lobbied them because
the
universities make a lot of money from foreign students, make a truckload of money.
Yeah, they need it.
Business investment, I'm putting on easing, still too low. This is part of the productivity stuff
Yep.
that maybe we can talk about next time. But we need CapEx. We need business to invest in machinery, equipment, AI, technology, and everything. And at the moment, business investment's actually down on where it was a year ago. Interest rates are a bit of a handbrake. Global conditions are a bit of a handbrake, but we need business investment to kick higher. Business confidence, the same. Commodity prices, they're neutral. They're neither here nor there. Stock market's booming.
As usual.
I'm going to put that as neutral because it's a good thing. It's a wealth effect, and there are good reasons for it. But, it's not a bubble. In fact, far from. I guess if stock prices were going up 50%, you might want to move it. But
just on that, just what's interesting about that, when you look at house prices and you look at stocks, both doing very well.
Yes, both near record
But the
highs.
people who benefit from that are the people who benefit from actually also benefit from a higher interest rate because they're generally speaking older people who are retired or have no debt or have very little debt. and they've got additional income and they invested in the stock market through super or some other mechanism, and or they're the same people going and buying houses, and they're the ones keeping.
They've already got the house they own. They probably have an investment property as well.
Yes.
Yep.
So that's very interesting that higher interest rates, generally speaking, suit those people because they've also got money in a deposit.
That's right. They're now getting 4-point-something% rather than back a few years ago 0.25 or whatever it was at the low point. So yes. In fact, can I just elaborate on that? When CBA, again, I'm sorry, I don't think I'm a fan of CBA, but they've just actually done some interesting stuff. I think it was actually in their company sort of 6-monthly update. They had a analysis of who is doing well by age cohort. 25 to 34 years old, 35 to 45. People who are 55 to 64, and then 65 plus, their spending is going up on essentials, spending on discretionary, holidays going up, their savings are going up, whereas the younger folk, let's call it from 25 to 45, spending on essentials is steady. By definition, you've got to spend it on essentials. Discretionary spending, down. Savings, down. And they're the ones that are being hit by these rate hikes. So your point is absolutely spot on, that while
we have two economies.
Talk about it,
we're parallel economies.
If you own your house, you've got money in super, you're loving high interest rates.
Yep.
If you're a young person with a big mortgage that you took out a couple of years ago and you've sort of got the cost of living issues and you've got a couple of kids at school and you've got a car and all those other things, your superannuation's still decades away. You're thinking, what's going on here?
And that's a parallel economy here, which is
correct.
Unfortunately, interest rate changes have a negative effect on one part of the economy, have a positive effect on the other part of the economy.
Correct.
And they're about a third each.
Yes, funnily enough, correct. It is exactly.
And but I mean, I sort of anecdotally, you go to the airport, any day of the week, and which I do every week. Traveling to the Gold Coast or to Brisbane, it's all folk over 55.
Yeah, not many young folk.
They're all going on holidays or going to Darwin for a weekend.
To their coast house or their holiday home, or
it's
having a couple of weeks holiday at Noosa or
and they're the ones who spend money and buy airline tickets, and the airlines can put the price up because they can surge them, and surge price, and all that stuff contributes to inflation. Is my point. And what happens is those people don't mind if inflation goes high because their interest rate's going better, they're earning more money, and because they've got less debt. But the problem is they're fueling, let's call it putting people in the poorhouse who are actually got a mortgage, who are younger.
Who are working their tails off to pay their mortgage, and have got other costs. Yeah. Again, if you're old, your kids have probably moved out, and you've got very few expenses.
Yeah, you're not as affected by the cost of living going up as you would if you're younger and you've got kids going to school.
And you've got food and all that stuff.
And you have to buy clothes every 6 months because the kids are growing. But if we could just go back to where we started in current rates, we know that
the current rates
they're restrictive.
They're restrictive, so put that in. That's it.
But if we could just go back to where we were talking about before, Kooky, it's the RBA's mandate is often referred to as a blunt instrument. We get all that, but in terms of being hawkish, I guess they've got to put blinkers on and not think about who's actually suffering. I mean, you and I are sort of sitting here worried about mortgage holders, etc., and maybe they should have had a rate reduction on the 8th of July and blah, blah, blah. But I guess they've got to just be data-driven. And we're only really interested, we're not interested in any particular cohort in the economy. Yep. We're only interested in the data to the extent it says that the GDP, inflation and or labour markets are out of whack.
And I think your point is very valid. The governor acknowledges that there are some people doing it very tough. She, to her credit and to her big credit, like seriously, because she occasionally gets asked at the press conferences and other parliamentary conferences, whatever, there are people hurting. She says, yes, they are. But she says, I can't have interest rates set for young people or for old people at a different rate. And it's a little bit like the state by state breakdown. Victoria should have a rate cut unambiguously. WA, if you were just setting interest rates for WA, probably have a rate hike, to be honest, because they're booming. Alas, it's one interest rate for the whole country. And so this complicates the RBA's job, just by the way, to cut them some slack. They're sitting there and they're hearing from their WA contacts, the house prices are booming and the economy's booming. I can't find workers because the mining sector's doing pretty well, and all of that sort of stuff.
They don't need a rate cut.
and you'd go to Victoria and think, oh, geez, things are tough. The government's sort of screwed up fiscal policy. They're going to hike taxes there and land taxes and property taxes. Oh, geez, Victoria, you need a rate cut. So that's what they're also balancing. It's not just, this macro, all of Australia, GDP, employment and inflation. They hear from different businesses, and even different businesses are doing differently as well, of course. So they're hearing from geographic differences, WA booming, Victoria and Tassie weak, for example. And then they're hearing on an industry basis that, housing construction is still going pretty tough at the minute. Retailing and hospitality is pretty tough. So they're hearing from a very different story depending on what you do. Whereas the services sector, health services, booming, that's the one where we've got that incredible growth in government-generated employment. And even if it's private sector, like childcare centres or whatever, it's still the government that's fueling that demand, if you know what I mean. So it's not necessarily a public servant, it's the government
it's the government's balance
stimulus
sheet
on that. Yep, correct.
So therefore, and we'll come back to see what your prediction is in a second, but therefore, do you think that the whole monetary policy then is a bit of a fiction? Given what you just said.
Look, monetary policy is really important.
The way it's styled. Yes, monetary policy is important. The way we do it at the moment, because given what might be
one
good
rate
for Victoria,
hike, is bad for WA, and what's good for retailing is bad for construction,
or what's good for an older person is not good for a younger person.
Alas, you've just opened a big can of worms.
Which is what I like to do.
You like to do that, I know. That's where government policy comes in. The RBA, let them set interest rates for the macro economy.
So you're now talking about fiscal policy.
We're talking fiscal policy, tax and spending. Where does the government, including state governments, by the way, not just the federal government, where do they raise revenue and where do they spend that revenue? Or
where do they give relief?
So in theory, and this is sort of part of this, I'll talk about the intergenerational one because that's sort of pretty clear to, I think, most people. I'll be blunt, and this is general because old people are doing it tough and some young people are killing it. But in a very broad sense, from the data that we've got, most old superannuants who've got truckloads of money in superannuation who own their house, they don't need any support. They're fine. As we were just saying, a young family, couple of kids, big mortgage, good jobs, so they're doing well. They're the ones that are under financial pressure, let alone someone who's renting, who's got maybe a modest income. They're paying so much more for their goods and services every week, their insurance and their body corporate fees and their rent and food and groceries and all this other stuff. I haven't got much of a pay rise the last couple of years. They're the ones that are under a lot of pressure too, and they tend
since 2022.
Correct, and they tend to be the younger age cohorts.
So we're nearly three.
What do you do about? So that's where the government's got to do things like, and look, the what do we call it? That relief on HECS debt, 20% cut in HECS debt the other day. Fair enough. Yeah, I think that was actually helpful.
Well,
it helps some of those people qualify for a mortgage down the track a little bit. So it's not the worst. Look, it's not the policy that I'd have as number one as the best policy I've ever seen. Far from it. But those sort of things it tends to be young people who've got HECS debt, So it's sort of those sort of things that can tilt the balance. And when you're saying we should be looking after the people who are exposed to the tough economic times and maybe not give so much support to those who are doing fine. It's the governments that do it.
That's the government's job.
Correct. Not the RBA. The RBA just interest rates. They're on inflation and full employment.
Right. So
that's how it should be.
So the RBA is, you're right, it seems to be correct. Be hawkish based on the data because you've got much better data than you've ever had before. And government, your job, and by the way, the RBA, not so much this governor, but previous governors have said, the government's fiscal policy is not doing anything to help things.
They have said that in the past, correct.
And I remember, you probably will remember this too, but I don't remember who it was. It might have been I don't know if it was Frank Crean or Simon Crean. But one of them was treasurer in the mid-'80s under Hawke.
Yeah.
Would that be?
That would be, I think Frank was Gough Whitlam, and I think Simon might have been in the 80s.
Right. So either one of them, and I don't remember whether it was Gough's period or whether it was Bob Hawke's period. But I remember very distinctly because I had one. People who weren't earning over a certain amount of money who had a mortgage got a tax rebate of the interest paid on their mortgage, and I think it was up to $1,000. and what it was is so it was means tested,
Yes.
and I was one of the people who got it. I got a tax refund of $1,000, and I remember at the time thinking to myself, that's a bloody good fiscal policy. That's a great policy, because I was quite interested in economics at the time. But I thought that's very good, because I know that I need that. I need that relief
now,
because the interest rates were quite high. We're going through an inflationary period, and you know, from both Goff and
back in those days, we had double-digit interest rates. I can't remember, whether it's the 70s or 80s, they were bloody high.
And if you remember, it was off the back of big spending by both those guys.
It was incredible. Yeah,
and you know, and that, as we know, and I think you and I have said many times over, governments create inflation by putting money in the system, and you know, for all the good reasons, they got to do it. We had to do it during COVID, etc. But you got to do these things, but people will spend it when they got it, and that will create inflation.
We do, yes.
Because merchants will say, "Wow, they've all got money. I'm going to put my price up because I haven't been able to do it for a long time," and that's what creates inflation. But I remember they had to bring interest rates in to kill it, and you know, that inflation, which they did. And I had a mortgage, and I was one of those people who's, when means tested, was entitled to get. I'm pretty sure it was either $800 or $1,000.
Back in the day, that would have been a sizable amount of money. With all due respect.
And it was, and it was a relief.
Yeah,
it was great when that check came in, mate. It was a big deal for me.
Yeah.
And I just wonder, is that the sort of policy you like the thought of as an economist?
Well, I'll turn it on its head. I don't like first home buyer grants.
No, this was.
But so I'm saying that's the way they try to help first home buyers. Because that just makes
the house price go up.
Whereas if you've got a mortgage and you're under financial stress and it's qualified, because again, higher interest rates are meant to cool the economy down, but you don't want to smash those most vulnerable, let's just say in the bottom quartile of vulnerability.
That was me.
So look, some people have got a mortgage and they're fine. You know, a lot of mortgage holders are absolutely fine.
Yep.
They took it out years ago. They've paid half it off. You know, they've got a pay rise since, and so they don't need that help.
But means testing will clear them up.
Means testing it is part of the thing. Look, I'd have to think about that a whole lot more, but I don't mind it. I think that there's something in that.
Because it's
a bit like the debt relief issue that we were just talking about for HEX debt. You know, fair enough, it's good policy, helps some young people reduce their HEX debt and all the rest of it. So a mortgage relief, I'll have to think about that, but I quite like it.
I'm pretty sure I'll go through
my old textbooks.
I'd love to know which one it was.
My history books. I've got a whole lot on my shelf at home, you know, years of Hawke and all that crap. You know,
because it wasn't as if I was one of those people who, like, just about every dollar I earned went to pay for my family or my mortgage. That was it. I wasn't one of those people who was contributing to inflation because I wasn't spending like a drunken sailor because I had nothing left.
Nothing left over.
So I needed that $1,000. And that was a holiday for me. I could take my whole family on a holiday
and do something nice. Which is so important. Yes.
And we'd probably just go down to, down to Bateman's Bay or something.
Yeah,
we weren't going on an international
holiday. Bay or Mollymook.
Yeah, it was Mollymook actually. I remember Mollymook.
Oh, I love Mollymook. Yeah,
put all the kids in the car and drive
Christmas.
down.
That's where we're heading for this Christmas.
I loved it. I mean, we rented a house or something. I can't remember what happened. But
great fun.
But that just. I'm just wondering whether that's, to our audience, that's where the government comes in. Fiscal policy is really important.
To help. And it's even the debate about superannuation now, without getting into the nitty-gritty of taxing unrealised gains, whatever. There are some people who've got bucket loads of money in their super. They don't need another tax break. Now, whether this is the right way to repair it, we'll leave that for another day. But, you don't need to add to the generosity to superannuation. I'll put it that way.
Yeah, I agree with that.
Yeah.
Well, Koogie, we've covered we've solved all the world's problems. But mate, what do you think is going to happen next week?
Next week, look, they're going to go. They're probably going to go 25 points. They have to, and I think, as Michelle Bullock said last time, it was a question of timing, not direction. In the period since the shock on-hold decision back in July, as we just said, we've had the unemployment rate going up from 4.1 to 4.3%. We've had the trimmed mean going from 2.9 to 2.7. So both are heading in the right direction for a rate cut. We don't want unemployment to go up, but as the board sits there next week and mulls over this sort of checklist on the economy, plus their modelling, plus they look at the global economy, 25. Again, it's one of those ones. What she says will probably be more important than what Michelle Bullock does, and so the statement that she puts out, fine, we'll read that. There is the monetary policy statement, which is the 60 or 70 pages of analysis of the economy with updated forecasts. So we'll pore over those. Plus, of course, she has the press conference at 3:30 Sydney time, where, and I must say the questions now are better than the very first couple that she did. So the journos have learnt to ask good questions. She'll be asked, and I dare say what she might say or hint at, and the board papers and all this other stuff will hint at, monetary policy statement will hint at. Here's the third rate cut in the cycle. We are happy with that, but we'll need more information on inflation, unemployment, economic growth before we move again. So it'll be, here's the rate cut, and don't expect one next time unless the data tells us. So again, getting back to that point that we made a short while ago about data dependency, and we look at data rather than preemptiveness. So it'll be one of those ones where, and if the data's crappy, they'll cut again. But if the data's okay, it doesn't deteriorate and there's a bit of more optimism in consumer spending and something, they'll be on hold for a few more months.
So it's interesting you said series, and we'll finish off on this, but and I asked your view on it, but generally speaking, as you and I know, well, up until 2010 anyway, the series were 5 up, 6 down, and over a period of a couple of years. And it was always considered to be, there will be a series of rate reductions. You just didn't get one.
Yeah.
Do you think the series, we have a structural change these days, and that we are not going to see series like we normally see?
I think you're right. And even if you think back pre-pandemic, I'll just have to double check my dates, but it was something from like 2010 to 2019.
Yeah.
There were the only direction rates was down, and there were periods of 2 years where they did nothing.
Yeah, correct.
They left them steady for 2 years, then there'd be one, and then they'd leave them for 18 more months. So that was the start of that 5 up, 5 down, or 6 down, 5 or 6 up or down, and that was the
death of it.
The nice cycle. That period, that was post-global financial crisis and really low inflation, if we think back then. Pandemic came along, that sort of stirred up all the economics of the world. And then we had, what was it? The equivalent of 13 25-point rate hikes, 425 points of rate hikes in that tightening cycle from 2022 to the end of 2023. So 13, it wasn't 6 or 7, 5 or 6. And okay, we've had 2 rate cuts, and we're not going to get 13 rate cuts this cycle. No, what? I'll swim across Sydney Harbour if they cut 13, back to 0.1%. It's going to be spaced out, as in duration between moves, and very, very cautious. I think that's this, and I think that's the methodology, and such is the nature of the economy right now. It's changed. The post-COVID is that we've got this incredible change in, and this is a question that I don't know any answers to, but the artificial intelligence change, consequences for employment, consequences for productivity, has consequences for the RBA and the US Federal Reserve and the Bank of England, all central banks and interest rate settings, because we don't know quite where this is going to go, to be frank.
And therefore, we would say to our audience, because, in the past we've always said this to the audience, the opposite to what I'm about to say, is that we would say, and the money markets are saying there'll be 2 more rate reductions, or the major banks are saying there'll be 2 more this year and 1 more next year or something like that. And I would say to our audience, and I wonder if you agree or not, don't listen to that stuff anymore, because I think Michelle Bullock's, you can listen to it, but don't put too much, don't put too much weight on it.
Don't put your house on it, so to speak. Look, it's interesting.
Don't plan with that.
Oh no, don't make a decision based on that. And again, and dare I say, and I don't mean to be throwing stones at Dr. Lowe, but his no rate hikes for 3 years was also part of the death of that preemptiveness as well, because that hurt the RBA. And at the time he made it, he thought, oh, fair enough, pandemic and all this other stuff. So I could understand what he was saying, but it turned out to be a mistake, as we all know.
Yeah.
And that's the death of why Michelle Bullock is very cautious. And when she asked, I can't rule anything in or out. They could go up, they could go down, and that's fine, because she's learnt from that, because she was deputy governor at the time. So she was well aware of the flack that created for the RBA. But I think in addition to that, it's just the dynamics of the economy. Now, it always changes, but this and I'm coming to terms with, as we all are, artificial intelligence. What's it mean? How's it going to work? What's it mean for jobs? What's it mean for wages growth? What's it mean for inflation? So there's all these unknowns. And while, we were saying before, stock markets are booming, and this is when the economy's mediocre.
So it's very hard to reconcile a lot of this stuff.
It is. So we're seeing some things now, and currencies are very different too, the US dollar and things. So global capital markets are changing. Again, this is sort of a really important issue for Australia too, for another day too. But we've got getting close to $4.5 trillion in superannuation money. I speak to some of the big super funds. They're over their eyeballs in investments in Australia. They can't buy any more Australian assets. They are putting their money into international assets. And it's not just the US or Europe. They're putting money into what we might call emerging markets in, Southeast Asia, in South America. Some of the opportunities there are incredible. And so that changes the dynamics of the economy.
Globalization.
So, globalization for capital markets. And you throw in the tariff stuff there, Mark. And so we look at where interest rates are being priced into markets. But as we've seen over the last little while, it's not a good guide to what actually happens.
So we might just finish off with this, but people need to understand we've gone through in the last couple of years, probably starting many years ago, but just the last couple of years, structural change.
Yep.
So what we've always known to be the case, we shouldn't assume that is going to be the position. That's the bottom line.
And I think that's feeding into the RBA thinking. And we were talking about that before. So the RBA preempted this. Maybe back in the day when Glenn Stevens was governor, you could sort of say, well, if I put rates up, I can see what's going to happen. Yep. Now, an interest rate change might not impact the economy like it used to, because of an interest rate change is not going to affect artificial intelligence take-up. That's happening. We're not a manufacturing economy that if you put rates up, people will buy less cars, so the car industry slows down. That was easy to work out. And, but those technological changes are happening whether interest rates are 0 or 10%, it doesn't matter. And but they do have an impact on the economy. And that's what we are all grappling with, including the RBA. Now, in the meantime, that's why they react each month or each 6 weeks or 8 weeks to what they're going to do.
Koukie, thanks very much, mate. I'll see you in a month.
See you in a month and a bit. Thanks, Mark.
See you, mate.
Cheers.